Hey Rebels, welcome back to the channel. In this video, we're going to discuss our predictive cycles. As we know, markets can very often mimic patterns of the past and cycles of the past. So we're going to take a close look at this year's cycles and see which cycles we're most likely going to be following and see if that gives us any insights as what could potentially happen the rest of the year. So if that sounds good, like and subscribe, and let's just dive in. I have in front of me this tool that I use very often that allows me to uh, add different cycle years. So what happened to the market 10 years ago, 20 years ago, 30 years ago? And very often what will happen is the market is going to mimic one of those decade cycles, right? And very often the 20 and 60-year cycle are very powerful cycles. And this is a composite of the two. So what I have right here, if I zoom in, is we can see that we're actually following quite nicely. It's not going to be tick for tick, but you can see that the major peaks and troughs are happening at similar times, right? It's going to give you a good idea of when these major turns are going to happen. Also, you can see right from the get-go, looking at the yellow line, that we were basically just tracking sideways. We weren't really trending. So for the first several months of the year, we knew that we weren't going to be trending. We were most likely going to be tracking sideways. That actual price action in blue is exactly what's been happening. And so we can see here too, if we zoom out just a ways, that in general, this cycle is not looking great for an uptrending year. We're most likely going to be trending down, is what we can see. The other one that I have here that can be useful is the midterm year, because we are in a midterm year. What can we deduce from that? If we click on the midterm here, we can see, yeah, really not trending until the end of the year. Around quarter three, we can see a major turn here into a higher low, and then we seem to be more clear trends at the end of the year. But yeah, basically just grinding sideways, not really going anywhere until the end of the year. If I turn that one off, turn on the 20 and 60, you can see a very similar thing where in this quarter three, we seem like we're forming a low and a little bit more clearer trends to the upside from there. Okay. The other thing I wanted to show you is that this fractal from 2020, this is us climbing out of the COVID low, and this is the tariff crash low of 2025, and this has pretty much been a mirror image the entire time. You know, we see we were starting to grind sideways there for a period. So during this time, it was like, okay, well, if we're following this and it's to continue following, most likely, sideways. That's exactly what happened. And then around this time started trending higher, and what we're actually seeing right now is a divergence from this. So, obviously no cycle is going to work forever. This particular fractal worked for over a year. That is very helpful. Now we are starting to diverge from that. So that also gives us clues. Like if we are no longer following this and this is grinding higher and we're starting to diverge from this cycle, well, something different is happening. And the other cycles are starting to paint a picture that we are, painting a picture to the downside. Okay. That's what we're seeing. And I also have an overbalance of time and price here. If you're unfamiliar, effectively, this is just a line that represents the deepest and longest correction during this uptrend. And if we post this from the high and we keep track of this as we go, what we can see is the bears have actually been able to push price down for longer than they have in the past. You can see effectively they've been able to push price down longer for this amount of time. We've maintained lower prices for this amount of time. Now, we can also see, if I pop this up here, if we start to see price action below this level, below these significant lows right here, if we lose that support, we will have officially overbalanced in time and price, meaning that if we do get a rally from here, which is kind of what it looks like from our predictive models, looks like effectively from March to mid-April, there's the potential for a rally here. So if we do get a rally from here, it just increases the likelihood that we're going to be creating a lower high rather than continuing on to all-time high prices. So that's really it for the predictive models. Pretty simple so far. I mean, I had to go through several models to see which ones were lining up correctly. It doesn't really give us percentage gains. That's not what we're interested in. We just want to know the market turns. Because actually, at the end of last year, all the Q4 models looked like we were effectively having higher prices at the end of the year, which matched the narrative beautifully. So that was kind of a positive sign for us. Okay, it's like, okay, we have all these narratives stacking up. They have that potential. Like everybody thinks Q4 is going to be good. And according to our models, that seems to be correct. And as we started to get into those times, we started to diverge from those models, giving us an early indication that, well, maybe we're not actually going to be following this model. Perhaps, we're not going to be following that narrative. That was one of many signals that we were getting at the time, indicating that, we were less likely to have further upside during that time, right? Many other signals, but that was just one thing to look at where we started to diverge early, just like we are diverging here. You want to pay attention to those and not necessarily play the game of catch up, right? You want to pay attention to those divergences because this is the market telling us in real time quietly that, like, hey, this time's a little different. We've overbalanced, we're starting to overbalance in time and price, meaning that the bears are in control for a longer period of time and able to push price down farther. And so we're getting a macro change trend. So that's something that we definitely need to be paying attention to. As far as Bitcoin, on the short term, major 50% level for the entire bull market, basically consolidating below that level. Not a strong place to be, not really where we want to see. Like, honestly, stronger market would have been dipping below here, coming up and consolidating just above this level. You know, seems like we're kind of splitting hairs there, but honestly, like these 50% levels are so powerful, and I've done dozens of videos walking through price action to show you how powerful they are and how markets are attracted to them and whether they consolidate below or above what that means for the strength. So it's like consolidating below this 50% level doesn't mean that we aren't going to get a rally from here. It just means that we're literally in a weaker position. So the rally from this point is most likely going to be weaker than if we had consolidated above that 50% level. As you can see here, honestly, like we come down here and we consolidate above this 50% level and we have a nice strong trend out of there, right? And that basically happened the entire bull market was we never consolidated below the major 50% level, okay? However, in the shorter term, we have talked about we had this extreme exhaustive uh, price bar to the downside with excessive volume, and we've been subtly printing higher lows ever since. And so we're grinding higher, very quietly grinding higher and starting to get strength above this level. So, this is a market that's primed for a kind of a sneaky rally where everybody's basically has their head turned. Nobody's paying attention. They definitely had some aggressive buyers during this time trying to buy the dip, and then it's been quiet for quite a long time. In fact, let me measure that because it's been quite some time. Yeah, over a month, basically, of just being quiet, just very grinding sideways, very subtly forming higher lows, meaning that people who, if they have been accumulating a position during this time, they're not selling. That's something to pay attention to. So obviously, the next levels above that would be this downtrend here, and we also have some more significant support and resistance to break through overhead. So lots of work to do for Bitcoin to be in a uh, real position of strength. However, does not mean that there's not tradable ranges here. Like, and I said that from the beginning, effectively, that that we were very exhausted from here, and this was a good place to basically form a base to potentially see higher prices. And from that low, not that anybody sniped that low, but if you did snipe that low, you'd be up 25%. Tradable ranges. 25% is a good year in the S&P 500. So, again, definitely tradable ranges here, but it just depends on your style. What are you looking for in the long term, right? So, for example, in the long term for me, and this is where I'm going to end it, is what's going on in the background is an 18-year real estate cycle. So real estate is basically the massive market that moves all other markets, and it follows its own cycle as well. It is basically the large tide that rises and sinks all the ships. So you can see that basically this cycle starts from a secular bear market. After this secular multi-year bear market, it's pretty much up only. You have 1 year bear markets, periods of maybe 1 year of a bear market normal, but nothing like what came before, a multi-year bear market. So for the last 14 years, nobody is expecting some multi-year bear market. They're just expecting more of what's happened in the most recent past. And so that's kind of where I'm at. For me, the big opportunity lies right here. And I'm going to tell you a story. Hilton, if you've ever heard of Hilton Hotels, in the at the bottom of one of these real estate cycle crashes, basically, I think it was like the Great Depression, effectively, was one of the other times that this has happened. Like I said, every 18 years. He bought his first hotel for $30,000. That hotel made him $30,000 a year after that, right? So it paid itself off in a year, and that's how he built his empire, right? So if you missed out on the moral of the story is that there's always opportunity in the markets. You always have to be studying the past to try to forecast the future as best as we can to stay on the right side. Effectively, we're just in the game of trying to buy before others are buying and sell before others are selling, right? Before the masses catch on, right? Which is actually a lot easier to do because usually the masses aren't convinced until it's all over, right? So it's actually really not that hard to front run the majority of people, right? Anyhow, so starting to see this round off, and the real estate market will peak long before Bitcoin and the stock market and all the rest of that. If this was the peak, let's see, if this was the peak, we've seen, yeah, almost 75 weeks. That's quite a bit. That's over a year since the peak. And typically, what you will see is the stock market peaking, somewhere around 12 to 18 months after the real estate market has topped. Now, we don't have confirmation of this being the final top yet. We're going to have to break some more significant lows here. Um, but we're well on our way. And in fact, we may really not get confirmation of this until much later, and at which point, we may be well into the start of our multi-year bear market. But we will see. Those are the things that I'm tracking that I want to keep track of. Leave some comments down below if there's any other markets that you'd like me to watch. I know that gold and silver and oil and other things like that are pretty exciting right now. So if you'd like me to do some analysis on that and show you my 2 cents and what I'm how I would view those markets. Let me know in the comments down below. Other than that, I think that's going to do it for the analysis here. And until next time, stay rebellious, my friends.